Well, hey there, everyone. Happy Tuesday, November 4th, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautifully sunny Redmond, Washington. Nice break from the normal rain this time of year, and I'm enjoying it. Uh, Speaking of rain, though, rainy day for the markets, right? Risk assets taking a big step back today. We're going to talk about the NASDAQ down over 2%, and that's not the worst of it. Cryptocurrencies, where you're feeling an acceleration in the pain. Bitcoin currently trading down around 99,000. That's down from around 107, 108,000. We were recording the show yesterday. That's a big change, and we're continuing to see risk assets rotate lower. You know, we've talked recently about the Hindenburg Omen, and boy, days like today feel like that's a pretty fantastic indicator to be ready and waiting for, because it implies that conditions are similar to where we start to have a pretty major corrective move. It's interesting, you know, some of the I've been reading as much as I could in the afternoons, kind of getting my head around how people are interpreting what's happening today. And the general narrative that I'm hearing is the fact that the markets have obviously, you know, overvalued by different measures. Earnings have been strong, you know, 80% of S&P stocks beating estimates, et cetera, et cetera. But a correction, you know, corrective moves are pretty normal. And that's 100% true. You know, just the fact that the S&P and the NASDAQ are down like they are today on its own, I don't think is enough to say this is a huge warning sign from a trend perspective. I would say there have been plenty of other warning signs. Hopefully you've heard loud and clear as we've been talking about weakening momentum, weakening breadth, weakening volume. These are all things that usually happen just before, you know, significant topping patterns. But from a trend perspective, the trend has still been quite strong. And as you'll see from the chart of the S&P, we're still in a pretty clear uptrend channel. We're not that far off of all-time highs. The issue, though, is that a day like today all of a sudden makes everyone realize that the market can actually go down. So it's less about whether the market pulls back. That's going to happen in any environment. It's more about whether dip buyers come in, as they have every time since the April market low. And if dip buyers do not come in the way they have every time since the April market low, that's when we know things are really getting significant. On top of that, you know, it's all about looking at lines in the sand, at moving averages. What concerns me about the crypto space, we're breaking the 200-day on the GBTC, on Bitcoin, on Ethereum. These charts are no longer great charts, you know, arguably good charts at best, and at worst, starting to be very challenged charts. So with that in mind, let's look at the charts and see what we can make of today's carnage, pure carnage in the markets. S&P 500 closing at 67.72. It's not lost on me, by the way, from the moment I reminded everyone that I agreed to play my trumpet on the show when the S&P closes above 7,000. From that moment on, I think that might have been the top, that moment when I mentioned that. For now, still no threat to play here, because we're at 67.71. Again, down 1.2%. To be clear, we are still within a shooting distance. I mean, within a very brief distance to all-time highs. So let's not get too worried too quickly. But I think what's rocking a lot of people today is the fact of what's rotating lower, right? This is a big risk-off move in technology. The NASDAQ composite down over 2%. The NASDAQ 100 down over 2%. Mid caps and small caps down as well, but not as much as large cap growth. Large cap growth has been the fuel for this relentless bull market off of the April lows. And as we've suggested, a change in leadership, right? If we see rotation away from that mega cap growth trade, there's just no way mathematically that our benchmarks would be able to sustain those gains if the juice is no longer working. And today it was certainly not working. The VIX still below 20. It did push up almost 2 full VIX points to around 19. So very much, again, heavier volatility, but still not excessive, right? A pullback in price, but not enough to be a clear bearish rotation on the daily chart of the S&P, which, to be clear, is still making higher highs and higher lows. But watching for spikes in the VIX is something I've learned to do. We may be in the midst of one of those here the first week in November. On the fixed income side, we can see that rates generally drifted lower as bonds rallied as stocks sold off. So the TLT, which is a bond ETF, up about 0.25%, 10-year treasury yield down to just below 4.1%. Long bond yield still around 4.7%. The dollar continuing to strengthen. And that's one of the few things on a day like today, you always want to focus on what's actually up. And so far, I'm seeing volatility up, bonds up, and the dollar up. And that is a 1, 2, 3 kind of trifecta of risk off movement, right? And that's what we're seeing. No love for precious metals. You may think, all right, gold and silver may be rallying as a safe haven play, except for natural gas, which was higher. Pretty much all the other commodities that we're tracking here with the major commodity ETFs were in the red. Gold and silver both down about 2% for the day. The GLD continuing to be in that pullback phase, breaking below the 21-day EMA. Certainly something to watch. But the real pain here, out of all the charts I've mentioned so far, cryptocurrencies, Bitcoin down another 7% today. We're down around 99,000. That's down from 125,000-ish not too long ago. Ethereum prices, 3,100. That's down 14% today. You can see the percentage down moves in different areas of the crypto space. Personally, I've been lightening up on Bitcoin, as I think I mentioned on the show yesterday. Bitcoin ETFs, I've been unwinding those and lightening up the position. Given the fact that we're breaking through support, given the fact that Bitcoin's clearly below its 200-day moving average. That's the kind of, trailing stops only work if you use them. So we've hit stops that I've agreed to follow. So I'm lightening up positions as I agreed to do, as I promised myself I would do. So here we are. All right, looking at the 11 S&P sectors, not horrible in terms of sector breadth, but 4 out of the 11 S&P sectors were up, and they're all pretty defensive sectors. Now, financials, number 1, up 0.5%. We've highlighted in recent weeks some of the stronger charts we're noticing in the financial sector. Ended up being the best performer today. Healthcare, number 2, up about 0.5%. Consumer staples and real estate, both managing to finish in the green as well. Utilities were down, but ended up being 5th. So it's all the defensive sectors plus financials at the top of the list. What's at the bottom? 2 growthy growth sectors. Technology, the XLK down 2.6%. That hurts. Consumer discretionary, the XLY down 1.7%. That hurts too. This is a rotation away from those leading growth themes, which have just been so dominant here in 2025, certainly in the last 6 months. The breadth has been negative. We've been covering that, I think, pretty closely here. So no surprise that we're seeing further negative breadth readings. On the New York Stock Exchange, about a 2-to-1 ratio, 67% down, 31% up. Worse on the NASDAQ Composite, about a 3-to-1 ratio, stocks down versus up. The S&P having the least bad breadth, but still not great. 56% of the S&P 500 members finished in the red today. So breadth conditions have been bad. And as we've talked about recently on the show, right, this sort of breadth divergence kind of resolves in one of 2 ways. Either the major averages start to roll over because the significantly negative breadth suggests a lack of participation, which implies a real lack of optimism underneath the hood. Maybe that's what we're seeing here on a day like today and this week, as we get the signs of hints of what could be a much larger corrective move. The other option is that breadth starts to improve as investors have a renewed sense of optimism, and that would be the way out of this. Is you get a pullback, you see buyers coming in, we end up making a higher low, and breadth and momentum start to improve. If you're all bulled up, that's what I would be looking for. Otherwise, this certainly seems like it could be the beginning of something more significant. The real issue here is less breadth. I think the story today, because breadth has been bad for a while, it's still bad. I think the problem today is some of these leading names that have been holding up did not hold up well. Tesla down over 5% today. NVIDIA down 4%. Palantir, which I don't have on this list, down 7-8%, something like that. I didn't check much going into the close. Apple, for what it's worth, was up about 1/3%. Microsoft only down about 0.5%. But this was a bad day for the leading names in the leading growth sectors. That makes 6 straight sessions going back to the middle of last week where we have closed below the open, and that's after these gaps higher to trade up to 6,900 for the first time in history. Look at all these heavy black candles. That's distribution, right? During the trading day. That's finishing in a position of weakness. That's implying short-term optimism, not widespread. All right, we're going to continue on here in a moment. As a reminder, we welcome your questions. We're going to be doing an all mailbag episode on Friday. But if you've got some nagging questions, if these moves, if the uncertainty that we're seeing in the market today is raising some questions about positions that you are looking at, charts that you're struggling with, stocks or ETFs you have questions on, make sure you join me Thursday, that is, Thursday, November 6th at 1 p.m. Eastern for Ticker Tantrum. We're going to do a live Q&A. For a long time, we've had live Q&A built into part of the show. We're changing the structure a bit and wanted to do a separate live Q&A so we could really focus on the questions you guys are sharing. You can learn more information at marketmisbehavior.com/ticker. You can sign up there. It is a free event. I would love for you to join. That's the same link you're going to use to participate in the webcast coming up this Thursday, November 6th, 1 p.m. Eastern. Bring your questions, bring your tickers along with you. We will get through as many as we can with our time together, and I'll look forward to having a lively, interactive discussion with all of you through that webcast format. All right, so here's what the heat map looks like. I mean, for you, for me, and I'm assuming for you as well, the bright red in the upper left corner certainly stands out. Microsoft and Apple, for what it's worth, had decent days. I mean, just weren't down that much or were up slightly. But pretty much all the other S&P technology names were down, and some of these were down significantly. This is the area of the market. Charts like Micron, charts like Applied Materials, charts like even Intel, charts like APH, Amphenol, charts like Lam Research. These are all stocks making new all-time highs going into the month of November, and all of them pulling back today. Now granted, those charts are still not horrible, right? I mean, if you look at the chart of, Micron, I mean, we're down one day off of making a new all-time high. So the trend is still positive. We're still making higher highs and higher lows. I think what a day like today implies that it's possible that we go a lot further. For me, is a brilliant wake-up call. It's kind of like when you're flying a small airplane and turbulence hits. Usually turbulence is just kind of a little something. It's a little air pocket. You kind of get through it. Even on a big commercial flight, sometimes you'll have bad turbulence, but it's kind of normal. And they kind of know they can, based on all the planes going through a particular, at a flight path, at a flight level, they kind of have a sense of, hey, we're probably going to have turbulence for the next 15, 20 minutes. A lot of times they'll announce that ahead of time because they're talking to other pilots and they kind of know what to expect. And you can kind of get through it, right? You kind of know it's coming. But if you're not expecting it, right? If that big move happens and you're flying in a little airplane, all of a sudden you hit a little pocket and boom, 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 boom. I mean, I'll tell you, your heart like jumps for a second, right? And you kind of catch your breath, and it's literally a wake up call. I mean, it wakes up all of your senses as you feel that things are not just straight and level anymore. Doesn't mean your engine's going to cut out or something horrible is going to happen and the plane's going to go down or something. It reminds you that is a very real issue that you are trying to avoid. And I think that is what a day like today probably has meant for many of you if you still have lots of exposure in this growth kind of leadership space. Those trends, that strength, that euphoric optimism is going to work until it doesn't. And when it starts not working, that's where there can be a flight to the exits. Maybe we're seeing the beginning of that here. Maybe this is just a brief pullback before we make a higher low. That's why we don't just sell or buy blindly based on what we're seeing on a heat map. We look at the charts, we set some rules, and we follow the trends. Trends in a lot of these charts are still pretty good. I would tell you again, the warning signs we've been seeing have been building. It tells me a corrective move of some sort the chances of that are very, very high. Hindenburg Omen, probably the most obvious example of that in the toolkit that I use. So we monitor, right? We look for breakdowns, and as long as charts still work, you want to keep them. And if charts no longer work, that's where we want to get out. We don't want to hold on to bad charts. A portfolio of bad charts is not a good portfolio. I just made up that quote. I like that one though. I might keep that one. All right. So growth leadership struggling. And it's not just in technology, which was, I think, the most obvious part of that. You also have the two big consumer discretionary names, Amazon and Tesla, which have both been, I mean, arguably some of the better charts you can identify, both down today. Again, still good charts, but not looking good today. Alphabet and Meta and Netflix, if you add that on, all struggling today as well. I mean, Meta has been a real downside outlier. This is one that's obviously broken down. The chart of Meta, I mean, just has been ugly, right? Since earnings, we gapped below the 200-day moving average every day, including today, continuing to close near the lows of the day. I don't see that as anything other than signs of further distribution and signs to not be particularly excited about owning Meta at this juncture. You know, Caterpillar, which looks more like a growth stock than anything else, pulling back after making a new all-time high yesterday. That might have been the end of last week. You know, so again, we're seeing pullbacks in a lot of these strong names. To be clear, right? When you see a day like this, I will often get questions on a chart like Caterpillar, right? Should I be selling Caterpillar because the market looks bad? And I am a huge fan of not making that sort of decision. I think your macro assessment is one piece of it. For me, that tells me how much I want to be allocating to new long ideas and how much I want to be spending my time on raising cash and unwinding unprofitable positions, right? Just in terms of general allocation. But in terms of security selection, in terms of what stocks or ETFs I want to have in a portfolio, if the chart of Caterpillar is still good, I don't care what the chart of the NASDAQ looks like. If Caterpillar still is justifiable based on the best practices of technical analysis and trend following, I don't think that changes anything, right? I don't think a macro pivot, I don't think a shift in macro theme should dissuade you from owning good charts. That is why I wrap the show every day with, it's always a good time to own good charts. If there are good charts out there, own those, right? And just the macro discipline for me helps me think about how much I want to be allocating to new ideas, whether I want to be adding new money to things, or whether I want to be more raising cash and getting more defensive and making sure that I'm lightening up on positions because of the additional risk of further downside. Charts like Caterpillar are still very good charts. All right, I think that's it for the heat map. Let's look at some charts together. And again, I think what you'll see is that while the markets were down today, a lot of the charts are not bad yet, right? And I say yet, implying that if there's further deterioration, things could get a lot worse for sure. I mean, even with today, which felt very bad, the S&P is still 4 days off of its most recent all-time high, trading above 6,900 for the first time last week. So we're closing lower today. We are still within an uptrend channel. This is why we drew the channel on the chart and left it there. Basically looked at the highs and the lows, pretty classic kind of parallel uptrend, what we'd call a trend channel of higher highs and higher lows. That trend is in place until it isn't. And the way you can tell it's no longer in place is we break below the lower boundary, which would tell us this is a risk-off move, or we break above the upper boundary, which is a warning sign that maybe we're getting a little too euphoric and a little too optimistic because the pace of the advance is accelerating. We're kind of going vertical. We're now still within that trend channel. So we're still making higher highs and we're still making higher lows. Get nervous when we stop making higher lows. That's the big thing. So 3 things I would be looking at between now and 6,500, where I would argue I'm certainly going to be lightening up on my own positioning. Number 1, the lower trend channel line. That's currently just above 6,700. Number 2, the 50-day moving average, which has served as support a number of times since the end of July. That's currently around 6,650. Then we have what we consider our most important line in the sand, 6,550, right? Because the point of this market, the uptrend, has been marked by a pattern of higher lows. We get concerned when we don't make higher lows, which means we need a low below 6,550. That would break that pattern that has been in place consistently since the April low. For now, still okay. With today's drop, the RSI is still above 50. So this is not a horrible chart just yet. And again, if this feels bad now, look back even just to February and March and see what more of a protracted decline in terms of percentage terms and time duration of cyclical bear phases, and you'll see that we could just be getting started. But what you also have to remember is this could just be within the normal sort of ebb and flow of a consistent bull market phase. All right, breadth conditions, as we've mentioned many, many times, and we will reiterate again, still not great as of today. We're around 39% of stocks above their 50-day moving average. No real change from yesterday. That's about where we were yesterday. Same as yesterday, about 55% of stocks above their 200-day moving average. I'm not going to spend any more time on that, but you're welcome to review my recent episodes where we talked about that in a little more detail. I did want to point out, by the way, this is the Hindenburg Omen indicator as referenced on the Stock Charts website. And that's the version that I have found most helpful. We've been talking about the Hindenburg Omen since early October, where we had that initial warning sign. We've now had like 3 separate signals of the Hindenburg Omen just in the last week, right? So last week and then again yesterday, we had all the boxes checked where the market's still in a long-term uptrend, which it is. The breadth goes negative, and that the McClellan oscillator is below 0. It is again today. And we have at least 2.5% of NYSE listings making new 52-week highs and at least 2.5% making new 52-week lows. That did happen yesterday, which meant we had another signal from the Hindenburg Omen. By my read, we've had enough that is a valid signal that suggests we are, a impending, most likely significant corrective move. Whether what we saw today is part of that larger corrective move, that's where I think you focus on lines in the sand, levels of support as we shared on the chart of the S&P 500. We've mentioned the anemic volume, and I wanted to point out the Chaikin money flow indicator on the SPY actually just went below 0 today for the first time since June, where it did it for about 1 day. And before that, you have to go back to the March, April kind of cyclical drop into the early April low. Chaikin money flow has been above 0 pretty much entirely May, June, July, August, September, October, again, except for 1 day here on the pullback in June. Today, we went below the 0 line, and that's not good. What that means is over like the last month, we're seeing more signs of distribution than signs of accumulation. The Chaikin money flow indicator is derived from looking at the daily volume readings and weighting those daily volume readings based on where we close within the high-low range every day. It's a brilliant way, I think, of comparing the volume, but not just attributing volume to an entire day's action, but really focusing on the direction of the close as an important part of that indicator as well. So Chaikin money flow going below 0, I think, sort of confirms what we had been fearing, which is that the volume has really been deteriorating and really showing signs of distribution. It really is classic signs in the last 6 weeks of investors selling into strength, and that's what I think that chart is referencing. All right, Bitcoin's not good, and to be clear, I do still have a position in GBTC. I do still have positions in Bitcoin and Ethereum. I did own some other Bitcoin ETFs. I've unwound all of those positions. I was lightening up on GBTC even more today. I'm a big fan of getting out of the way when my stop is hit. And I tell you that not to brag that I'm great at it, because it's as hard as me to sell out of a position, especially one like Bitcoin that has been a fantastic position in my portfolios in 2025. But the whole point of a stop is gone if you ignore it when it happens, right? So I could try to tell you, all right, maybe this is just like what we saw in April, and maybe we're right at the 200-day moving average, and that's a perfect time to buy. That may be true. But what I've learned is with a position like this, once you sort of set up your framework and once you set your stop, which for me was below 82, that broke today. And I had been lightening up back here because of other indicators that had started, initial warning signs that told me we were starting to show some distribution. Today was enough for me to start lightening up a lot more, which I'll probably continue to do as long as we keep showing weakness. Nothing would give me more pleasure than this chart just magically getting better tomorrow and starting to break back above levels where I'd feel comfortable reopening positions and getting back in. But for now, that's the reasoning. In this case, what you have to remember is we did make a lower high. We stalled out in an attempt to get above the 50-day moving average. And this traffic light technique, for me, happens when it's clear on the chart that we're kind of in a neutral range. And I think for the last couple of weeks, Bitcoin has been choppy, sloppy sideways. And I think this chart presents a pretty clear opportunity of above 90. GBTC's pretty constructive because we're making a higher high and breaking above that swing high from about a week ago. Bitcoin between 90 and 82, this is GBTC again, is neutral because we're still kind of treading water between moving averages. But break below 82 for me tells me we're now below the 200-day. The momentum is clearly negative. We've been below 50 for the last couple weeks. This is a chart that's distributing. And so to avoid participating in a big protracted decline, I'm choosing to get out now and log some gains from the run higher and wait for signs of accumulation to get back in. Keep watching the show. Keep following my work. I'll certainly keep you updated as that chart certainly evolves rapidly, as we're seeing here. Ethereum arguably looks even worse. While Bitcoin has been broken down, we actually, talked, I think, about the chart of Bitcoin on yesterday's show. Ethereum looks even worse. It's been underperforming Bitcoin. Today, actually, Ethereum oversold for the first time. It was almost there at the end of September. You really have to go all the way back to the April low. And look at what happened during this downtrend from December 24 into the April low. RSI spent almost the entire time below 50. RSI often became oversold on sell-offs. That's kind of the vibe I'm seeing here more recently, where the RSI is getting down to 30 and today actually getting below 30. And on rallies, we're not getting much above 50, certainly not above 60. And so the range of the RSI has drifted down to more of a bearish phase. This tells me this is a chart in distribution, and I want to be out of the way. Next downside objective, I would say, given a confirmed break below the 200-day moving average, 2750 would represent a 61.8% retracement of the April low to the August peak. 38.2% of the way was right at 3,600. That ended up being the swing low there in early October and led to this kind of consolidation phase. I think breaking below there was a negative confirmation, not holding the 200-day concern as well. Now, when I think about, a major market top and what it looks like, we've been, all the early warning signs that I look for we've seen them. And it always starts with bearish momentum divergences, which we've, I think, covered quite heavily, and bearish breadth conditions, which we certainly refer to quite often. Then you get to what I call structural indicators that show that there's a rotation happening and that investors are rotating to get more defensive. There's two things that I look for there. Number one, whatever was working in the previous cycle starts to not work. That's often a pretty classic sign of a major market top. I think semiconductors, using the SMH, probably the best example of the AI trade. This is an ETF that shows the strength in these leading growth names in the technology sector, the strength of the uptrend, the acceleration that we've seen going into the month of November. To be clear, I don't think this is a bearish chart yet. We're still above an upward sloping 21-day EMA. The moving averages are still in the proper order, but if we failed to hold the 21-day EMA, that would be a check in the negative column. We failed to hold the 50-day, which is what sort of ended up being the low in August and September. That would be another big red flag as well. The leading indicator, which is a bearish momentum divergence, pretty clear here going into the month of November. So does previous leadership, semiconductors, particularly on a relative basis, start to rotate lower? Last week, we're just seeing a bit of a turn lower in the relative strength, but I would say the relative strength is still pretty good. That's an important chart, arguably the most important chart to watch for rotation. The other thing you do, and this is the other item on my list, would be an improvement in defensive sectors, right? If investors really start to get nervous, they don't just start taking profits in winning positions. They start getting more defensive, which means sectors like utilities, healthcare, consumer staples, and real estate should all start to improve on a relative basis. What we're seeing this week is just this little hook at the end. They're all turning higher today. Does this become more of a stretch of outperformance for those defensive sectors? And if so, I think that would be a very bearish sign, something certainly to watch. Another thing in terms of leadership struggling, let's keep in mind that Meta has already broken down below its 200-day moving average and trending lower. Netflix still holding up around $1,100 a share, but also below its 200-day moving average for the last week and a half. Microsoft is maybe the most concerning of all. But I mean, Meta is bad because it's breaking down and just keeps going down. But what concerns me about Microsoft is we gapped higher on a pretty decent earnings report. We gapped up to the previous all-time high, and then that's been it. From that moment on, Microsoft has been selling off. Even the day that it gapped higher, it closed near the lows, and we've closed near the lows pretty much every day. Today actually closed a little bit above the open. That's the first day since that gap that we've seen that. So I think the lack of follow through on Microsoft is also a pretty concerning development. Hey, it's not all bad. I had to search around for a stock that was actually up today, and I say that in jest. There's plenty of things that were not down today. It was just the big stuff that's been up so much that was down, and that's why this market feels so negative today. But there were things that were higher. I got a question in the chat. I think it was maybe yesterday at the end of last week about Berkshire Hathaway and what to make of this chart. So with a chart like Berkshire Hathaway, right? I mean, this is a perfect example, I would argue, to look at moving averages, to look at support and resistance levels, to look at Fibonacci retracements. Now, why is that true? Because we're in a range, right? If you look at where we're at and look to the left, we can see clear resistance around the 505 to 507 range. That's the high from October and the high from early September. We have clear support. Most recently, the lows just from the last week around 475. The low from August around 455. So I think we have some clear levels where we've seen support and resistance. We can also use Fibonacci retracements, which have actually been quite helpful here, I would argue. 38.2% of the way back up after the sell-off May into August. 38.2% of the way up is around 488. We had a little choppiness there in August. We ended up having that turn into support here in September and October. That's why that breakdown below Fibonacci support, below the moving average was, I think, pretty significant. Today's rally is encouraging. I would love to see a break above the 200-day moving average, which would also get us back within kind of the neutral range of the Fibonacci retracements. But for me, Berkshire above 510 finally shows accumulation, and not just a one-day accumulation, which is what we're seeing today, but more sustained accumulation. So for me here, this is a trade. If you're buying into these lows, that's a trade. Saying, all right, I'm going to bet we can return back to the moving averages, or maybe I would play a return back to these previous swing highs. That's a bet on mean reversion. For me, I'm more of a trend follower, which means I want to see this trend show that there's accumulation. So getting above the moving averages and sustaining that breakout, getting above the swing highs, getting above 510, that would suggest to me there's optimism in this chart. RSI pushing above 60, getting more toward the overbought region. That would be a nice way of validating a potential breakout. For now, a chart like Berkshire, for me, unproven, and I think not ready for the optimism. Folks, that'll do it. By the way, if charts like Berkshire are on your list and you're struggling with them, don't forget our live Q&A called Ticker Tantrum coming up this Thursday, November 6th, 1 p.m. Eastern, 10 a.m. Pacific. You can get more information on that free live Q&A session at marketmisbehavior.com/ticker. For now, I will say have a wonderful Tuesday evening. I hope this helped you make sense of the markets today. Please stay tuned as we track this potential corrective move in the month of November. But have a great evening. And remember, it's always a good time to own good charts. Take care, folks.